If the Federal Reserve cuts rates in September and a brand new Fed chair takes the wheel next, the entire playbook for stocks, bonds, real estate, and crypto resets instantly. Today I'm breaking down what just changed, who's on Trump's shortlist to run the Fed, what a cut does to your money, and the smartest moves to consider before markets reprice. Fed Governor Christopher Waller repeated his call for a September rate cut, citing a weakening labor market. Translation: the higher for longer era might be ending. Not in theory, but in the next meeting on September the 16th to 17th. Meanwhile, President Trump publicly confirmed 3 finalists to replace Jerome Powell: Kevin Hassett, Christopher Waller, and Kevin Warsh. Markets now have to price not just the next cut, but the next regime. Labor data has cooled versus expectations, raising recession risk even with headline GDP still decent. When jobs wobble, the Fed tilts dovish. That's the playbook. Markets are now assigning high odds to a 25 basis point move in September, with debate over the pace afterward. The message from Waller is simple: cut now because of labor, then go data dependent on how fast to ease next. Now, let's talk about the shortlist. Kevin Hassett is traditionally pro-growth, market-friendly, and tends to favor accommodative policy to support employment. Expect an easier policy bias if growth slows. Christopher Waller is already inside the Fed and has argued for a cut. Markets may see him as continuity with a dovish tilt. Kevin Warsh is historically more inflation hawkish, but open to easing in downturns. Markets might price less aggressive cuts under Warsh versus Hassett or Waller. Here's what it means for assets. For stocks, rate-sensitive names like small caps, REITs, and utilities usually benefit as discount rates fall. Big tech and AI stocks also pop on lower yields, though policy risks like chip restrictions remain a wild card. In bonds, front-end treasury yields lead declines on a confirmed cut path. Duration outperforms if markets price a series of cuts rather than a one-off. For the dollar and gold, a cut generally pressures the dollar and supports gold, but the chair pick matters. Hawkish leadership can cushion the dollar's drop. And crypto, especially Bitcoin, could get liquidity tailwinds from easing plus ETF flows, but volatility will spike around the Fed meeting and chair headlines. Let's lay out the scenarios. First, a cut plus dovish signals. Risk on, yields down, dollar softer. Second, a cut but with hawkish forward guidance. The knee-jerk pop fades, curve flattens, and quality outperforms. Third, no cut but dovish projections. Expect a volatility spike, but it's a dip-buying setup if easing is clearly telegraphed. Fourth, a surprise hawkish chair choice. Dollar jumps, growth stocks fade, and commodities wobble. So what's the playbook? In equities, overweight quality growth and domestic cyclicals that benefit from lower financing costs. Add small caps on weakness. In fixed income, ladder into 2 to 7 year duration, add investment-grade credit selectively, and keep dry powder if spreads tighten. Hedge with gold or long-duration bonds, and consider a small hedge against dollar downside. For crypto, scale entries around key levels and size positions carefully. Macro headlines can whipsaw the trade. The key catalysts ahead: the Fed's September 16-17 meeting and any White House announcement on the next Fed chair. These are market-moving events in their own right. The story isn't just a cut, it's who runs the post-cut Fed. Get your plan set before headlines hit. This is how you trade the path, not just the print.